Today's episode of The Unlock is brought to you by YCharts. Election day is just days away, so clients have a lot of questions. We get a lot of questions of this all the time. How is it going to impact our portfolio? How is it going to impact market volatility? That's where YCharts election guide comes in, providing you with everything you need to address their most pressing questions with confidence. So there's tons of uncertainty. What's volatility going to look like? Should I move to cash? Should I change my portfolio? YCharts helps you cut through the noise, offering some easy to understand visuals, which is great, some insights tailored to advisors to help these critical conversations. Get your copy with a link in the show notes to unlock exclusive access, downloadable charts and visuals. It's a really great way to communicate with your clients in this uncertain time. Don't forget 20% off your initial YChart subscription when you tell them the Compound sent to you. New customers only. Link in the show notes. Check it out, ycharts.com. Welcome to The Unlock, our channel here at the Compound, built exclusively for financial advisors. We're tentatively calling this show Ben with Benefits. It's a little catchier name than we had before. Josh came up with that. This is a show where we're going to explore research, data, psychology behind the most important topics for financial advisors to grow your business and better serve your clients. My basic thinking here is financial advisors don't have time to sort through all the data and research out there, so I'm going to do it for you, and I'm going to bring on experts to help explain it all in plain English so you can figure out best practices, strategies, and opportunities for your clients and businesses. Today's show, we're joined by Shawn O'Brien. Shawn is the Director of Retirement at Cerulli Associates. Shawn, welcome to the show.
Thank you very much, Ben. Glad to be here.
So I regularly speak to financial advisor groups across the country, giving speeches, and I'm updating these presentations to get the state of the industry. I talk a lot about RIA size and size of retirement plans and these sorts of things. And invariably, when I'm trying to update some of this data, I come across Cerulli as a purveyor of this data, right? As the most reliable source. So how did Cerulli get to this point where you are kind of this aggregator of data for the financial services industry?
Yeah, it's a great question. Cerulli, going back, was founded about a little more than 30 years ago by Kurt Cerulli, who's still the CEO of the company. And, over time, we've built out 4 different kind of research franchises covering the asset and wealth management industry. We've got a wealth management research franchise, a retirement research franchise, an institutional research franchise, and then product development, which kind of overlays those 3 broad distribution channels. If you think about how we came about all of this data, it's really a summation of everything we've accumulated over the course of that 30-year period. So we didn't come out the gate with fully fledged retirement market sizing. We've developed it incrementally over time. And then through various phases of Cerulli's history, we've engaged in strategic consulting work as well. So right now, we are offering strategic consulting services on top of published research, but it's something where we constantly innovate upon what was there before us across all 4 of these practices. And I think what really dictates the way that we gather data is what our clients are looking for. Our clients are largely asset and wealth management firms. And so when we think about market sizing, industry trends that we're trying to cover quantitatively and qualitatively, it's really with their strategic priorities in mind. And that's how, loosely how we got from, a company founded by Kurt 30 years ago to where we are today.
So you focus on the retirement side of things. So what questions are you trying to answer for your clients in that space?
Yeah, I mean, we have, just to give you a little backdrop, we cover the retirement market from almost every angle possible. So market sizing is, a good starting point. We're going to size the U.S. retirement market from the top down. So we're sizing the defined benefit market, we're sizing the defined contribution market, and we're sizing the IRA market by assets, number of plans, number of participants, et cetera. So just looking at that addressable market for our asset managers from a quantitative standpoint, and we'll slice and dice, 401k market sizing data in all different types of ways. But we also, we're surveying plan sponsors. So my team focuses mainly on the defined contribution market, and we'll survey 401k plan sponsors, we'll survey 401k participants, we'll survey DCIO asset managers. So those are asset management teams focused on the defined contribution market. We'll survey target date managers, defined contribution plan consultants, retirement plan record keepers. And ultimately, what we're trying to do is glean insights around what these various stakeholders within the retirement markets are thinking and doing and planning so that our clients, asset managers, retirement plan providers, wealth management firms, can have a sense of what's going on at the industry at any given point in time from various perspectives, and then triangulate that with our market sizing data to try to, get a better sense of what their strategy should be for the U.S. retirement market. That's how we think about it.
So you sent me a bunch of data and research on the defined contribution retirement space, which I've been contending for a while now. I think is one of the biggest stock market forces of the past 30 or 40 years. Just this idea that we went from this defined benefit age where pensions were done for you, and now you're on your own for saving for retirement, and we've built up all this money. And I think it's a massive opportunity for financial advisors, which are in the decades ahead, which I want to get into. But give me a sense of the size of this market. How much money is in the defined contribution space these days?
Yeah, so our most recent sizing puts the defined contribution market at a little over $12 trillion.
Wow.
To put that in perspective, the entire IRA market we size for plan year 2023 at a little more than about 13.5 trillion. So this is an enormous market, and most of that defined contribution market, that a little more than 12 trillion, is in corporate defined contribution plans. So and largely 401k plans. So
that includes like 401ks
Yeah.
and 403bs and 457s, all those different numbers.
That's
But
right.
mostly 401ks, I assume.
Yeah, so 401ks are a big swath of that. So the 401k market, the corporate DC market is a little less than 8 trillion. And then the rest, a little more than 3 trillion, is what we would call public DC. So that would be 403bs, 457 plans, and the federal thrift savings plan, which is the largest defined contribution plan in the entire U.S. by a long shot. That's about an $800 billion plan for federal employees.
So when it comes to this 401k and the like money, this $12 trillion, I think it's a massive opportunity for financial advisors. And I think in a lot of ways, some of them don't really see the opportunities quite yet. I want to read you something that you put in one of your reports that came from Morgan Stanley's James Gorman in one of his earnings calls. And he said, he's a CEO at Morgan Stanley. In a decade, we'll look back at this firm and say that our workplace business was the most significant strategy change. And I missed this at the time when he said this. This really surprised me. So even if a company like Morgan Stanley is making a big push into 401ks, what's the play here for them? What's the strategy? Why would they want to get into this seemingly boring business?
Yeah, it's a great question, because from an economic standpoint, you could look at it that way, that this is a boring business that kind of just chugs along. It's highly regulated. There's not a ton of innovation, relative to other areas of the asset and wealth management industry. But Morgan Stanley has done a great job of using the workplace as a way to establish relationships with end investors earlier on than other advisory firms might think to establish relationships with them. When you think about what a retirement plan means to end investors, it's often for, in today's terms, Gen Z, millennial investors, their primary source of financial guidance and advice. And it's their retirement plan provider and their plan advisor are really, in a lot of cases, their main point of contact when it comes to speaking with any sort of financial expert. A lot of these investors haven't accumulated the wealth necessary to really go out and get a proper high-end financial advice relationship and work with an advisor in a wealth management context. So
you're
Morgan
getting
Stanley,
to these people while they're building their wealth before they actually have it.
Yeah, in a sense, yeah. And sometimes they already have, some pretty significant wealth. Some investors, some cohorts we might call Henrys, high earners, but not yet rich, would be an example of that. They've got pretty significant wealth, but they aren't, high net worth investors yet, right? So Morgan Stanley, they offer stock plan administration, they offer plan advisory, they offer financial wellness, they offer non-qualified deferred compensation. These are all ways to really just establish relationships with investors who may be wealth management clients today or could be soon. And they've got, like I said, 4 or 5 different avenues through which they're achieving those relationships.
So I want to talk about that piece of it where you take someone who's a 401k investor and eventually they become a wealth management client. But I also want to talk about just the management of the 401k plan, because to me, from the outside, we have a 401k division within Red Holtz Wealth. But just from having jobs in the past, it seems like such a scattered industry. You have these huge behemoth firms that run some of this 401k money, Fidelity and Vanguard and some of the Empower and some of the well-known places. But then you also have an HR department at a small business who says, oh, my brother-in-law told me about this firm. And it's some firm you've never heard of. And it's got crappy funds. And so I'm just curious, what does the landscape look like in terms of 401k plan providers? Is it concentrated like the S&P 500 where there's just a handful of small firms that control all the assets? Is it really widely dispersed? What does that look like?
Yeah. So there are, there are a lot of different retirement plan providers, like you said. A lot of them are not household names. These aren't firms that your everyday investor is going to be familiar with. But what we have seen over the years is consolidation in the record-keeping retirement plans provider space, what we call the record-keeping space. And part of the reason for that is because the margins in retirement plan record-keeping, if you're just a pure play retirement plan record-keeper, are incredibly thin. And there's a lot of investment that needs to go into this business year after year. So it's, from an economic standpoint, it's not a highly attractive business to be in.
So you need scale.
Right, exactly. So you need scale. That's what I was getting to. And what we're seeing is that we're seeing record keepers acquire other record keepers to achieve that scale. So yes, we have a high concentration of assets with a handful of record keepers, being Fidelity, Empower, TIAA, who dominates the 403B space, and then a few others, Vanguard, Voya, Principal, and they're really holding the vast majority of assets, especially in the 401k space. TIA is kind of an exception because they just dominate the 403b space. But Empower acquired Mass Mutual's retirement plan record keeping business a few years back, and then shortly after that, they acquired Prudential's retirement plan record keeping business. Voya just acquired One America's retirement plan record keeping business, or announced that earlier this year. And so you've got these pretty big acquisitions happening, one or two happening, year after year, to further consolidate those assets among the top retirement plan record keepers.
So I'm curious where you think financial advisors fit into this. And I love some of the language you use in your reports where you talk about how some advisors are like dabblers in this space. Mm-hmm. And there's others who specialize exclusively in 401ks. And your advice was that it probably should be a little bit of mix of both, not just people who focus exclusively on 401k plans, but also other advisors that can come in and give advice. So where do you think financial advisors fit into this space? And maybe you could walk through some of the different ways that advisors can work with them. Because I know there's these 338 plans and 331s. There's a lot of numbers in this space. And I'm not sure I exactly understand what each of those numbers means. Maybe you could talk about what that opportunity set looks like for advisors who want to get into maybe this administration of 401k plans and what it even means for them to do that.
Yeah, I think for an advisor who doesn't specialize in this space, so let's take those specialist advisors that you mentioned before who are really dedicated to the defined contribution space, the ERISA covered space, and let's set them aside for now and talk about those dabblers and other advisors who aren't specialists in the retirement plan space. Why should they be interested in this space at all?
Right. So, sorry to cut you off, but most of the like RAs I know, they have a wealth management client who will say, "Hey, I own a small business. Can you do the 401k for me too?" And it's like they fall back into this business. It's not like they're out seeking it. To your point of the dabbler.
Right. So right. We would call those accidentalists. A lot of different names for that. Right. So for advisors, I think, they have to be thinking about what retirement plans mean within their broader book of business. And one theme we're seeing then within the retirement and wealth space is this convergence of the two markets. And Morgan Stanley would be an example of how that's playing out, their Morgan Stanley at Work solution. And so advisors, if you're looking at the retirement plan business as something that's highly regulated, you don't know what ERISA 338 versus 321 means, you're worried about what ERISA means for you in the first place and what that actually entails. And, the margins aren't as great as doing traditional wealth management. You grew up doing traditional wealth management. Well, think of the retirement plan space as a way to strengthen relationships with those small business owner clients. So like you said, you're an advisor, you've got a wealth management client who's a small business owner. He or she needs to offer a retirement plan in many states moving forward. California, Illinois, Oregon, they're mandating that businesses above a certain size and going down to very small businesses offer a retirement plan to their employees or join the state-sponsored retirement program. So you're going to have a lot of these business owners who are saying, look, I need to do something here. You're my advisor. What should I do? And are you going to advise that small business owner on their retirement plan, or are you going to let someone else come in and do that? Or are you going to let some other firm that specializes in that do that and then potentially encroach on your wealth management relationship? So there's that. And there's also just the ability to speak with end investors on a one-on-one basis. Plan advisors, participants are working with plan advisors, especially in the small to mid-sized 401k plans, on a one-on-one basis quite frequently. And whether that's through enrolling in the 401k plan or subsequent conversations about just general financial planning topics. And so those higher balance participants could be potential wealth management clients for you. And so for advisors, it's a potential kind of source for new wealth management clients and a way to diversify kind of the way you source those wealth management clients beyond just referrals and other things you're doing in the wealth space.
I'm curious, you mentioned a little bit in your piece about how advisors can work with 401k participants, beneficiaries. And one of the things we've done, I've done a few of these presentations myself where I go into a 401k group and there's 70 people that are part of the plan, and I give them a presentation, just some basics about diversification and asset allocation and expectations within asset classes and some of the stuff that these people need, automatic investing and rebalancing and all these things. What do you think is the amount of heavy lifting that needs to be done by a financial advisor in terms of that kind of education?
It really varies. So what we're seeing now is that a lot of, especially at the broker dealers, the wirehouses, big national regional broker dealers and independent broker dealers, they are trying to support advisors who want to do retirement plan business as much as they can. So providing them with that type of material or those type of speaking points to share with participants or sending a specialist in to have those conversations might be an option. And so for a lot of advisors, they're getting support from not only their home office at these BDs, RAA consolidators and aggregators as they continue to roll up RAAs. They might be getting it from those home office teams as well. And asset managers, they might come in and say, hey, look, advisors, these are some issues you might want to be talking about with participants as you meet with them in seminars or one-on-one sessions, or plan sponsors moving forward. Secure 2.0 is a huge piece of legislation that passed, recently. And that's very much on the mind of advisors. So I think there's a varying degree of kind of autonomy there. So specialists they're gonna know what they're gonna want to present to participants. They know their talking points. They know they probably have a pretty good sense of what's on the mind of plan sponsors and their participant base just from dealing with them and being in this market for so long. But for the non-specialist advisors, I think they can really lean on the home office and asset managers, their asset manager partners, to help them kind of guide the conversation around those presentations, if that makes sense.
How about like the model portfolio thing? Do you think it makes sense for advisors to come in and say, we're also going to help give you advice on asset allocation. We're going to give you these 3 model portfolios, right? A conservative, moderate, and aggressive, whatever it is. Does that make sense? Does that move the needle at all for people?
I don't think it's a huge game changer for advisors. Model portfolios are not that prevalent in the DC space, although they are becoming obviously much more prevalent in the wealth management space. Target date funds are getting you pretty close to that with an age-based portfolio for the most part.
Right.
Where we're seeing, kind of new product development is around advisor managed accounts within the retirement space. And in a nutshell, these are just personalized asset allocation portfolios largely using funds within the plan's lineup that are tailored to the end investor's needs and circumstances. So we have managed account programs that have been within the defined contribution system for years. Some examples are like Edelman's Financial Engines, Morningstar. Fidelity has its own proprietary managed account program that offers within 401k plans. Advisors can partner with a firm like Morningstar or a fintech company called iJoin or a few others and white label that solution and make it partly their own and in partnership with those firms. And they can offer essentially personalized asset allocation to those participants within the plan and also layer on top of that personalized advice. So if the participant has questions about when to claim Social Security or has a question about healthcare expenses that they might be facing as they near retirement or budgeting or any financial planning related topics, that advisor might work with that participant in a one-on-one basis through that managed account kind of medium to address those questions as well.
Now, when financial advisors come in and they're going to take over one of these plans, how often do they stick with the plan that's in place, and how often do the advisors say, "Hey, we have a partner that we'd like to work with. We're going to come and clean house and give you a whole new administrator"?
Yeah, so advisors have a lot of sway over the record keeper, the retirement plan administrator. We do know from talking to advisors that they do have preferred record keepers, and a lot of these home office major broker dealers in particular have arrangements with a specific set of record keepers, 8, 10, 12 record keepers that they can specifically offer off-the-shelf, home office curated 338 lineups through. And so a lot of these firms do have preferred record keepers. They have record keepers that they have specific partnerships with to offer home office curated investment lineups. And they also just generally prefer working with some record keepers over others for one reason or another. Advisors really value, our survey data tells us, and our executive interviews with advisors tell us that advisors really value relationship management that record keepers can offer. So while it's a really fee-sensitive market and plan sponsors are always concerned about the fees associated with record keepers, advisors have told us, look, they're all pretty cheap. We want to work with the record keeper that's going to make our life easier and the plan sponsor's life easier, as simple as that sounds. So being able to call someone at a record keeper that you can talk to immediately and not be held on a 1-800 wait line or something like that, that goes a long way with advisors and record keepers who actually understand the retirement plan space, because there are some record keepers who are, I would say, have more in-house expertise around retirement plan administration and compliance and filing 5500s than others.
So you mentioned that this is kind of a low margin business. What kind of average fees could advisors expect to charge in this space?
Yeah, our survey data from our retirement specialist advisor survey suggests somewhere between 55 and 60 bips is generally the median, but it's largely based on plan size. The larger the plan, the lower those AUA-based fees are going to become. And for really small plans, advisors probably have some sort of flat fee minimum in a lot of cases that they're going to charge. So for a $1 million plan, they're probably going to have a flat fee minimum for those types of plans rather than a $20 or $30 million plan where they're going to charge an AUA-based fee.
Now, I think that I like your idea of sort of using the 401k plan as an entrance into getting other clients. And so you mentioned the Henrys, the young people who are slowly but surely building wealth. And maybe it's a lot of those millennials now that are slowly but surely getting up to, I don't know, 6 figures in their 401k plan or whatever. And you're coming in to offer advice that eventually they'll be a wealth management client. Obviously, the bigger opportunity set, I think, in the years ahead is the IRA rollovers from 401k plans and the baby boomers that are going to be coming out. So my favorite stat I like to use with everyone is 10,000 baby boomers retiring every single day between now and the end of the decade, right? And a lot of these baby boomers, through the accumulation phase, maybe they haven't had a financial advisor. And for that, the part of the accumulation phase for them is a lot easier than the distribution phase, right? Because now they're thinking about these rollovers and where do I move it to? And I have taxes to think about and estate planning and insurance. And now I need a retirement withdrawal strategy. And so we're getting a lot of these former DIY investors coming to us saying, my financial life is way more complicated now and I need an advisor to help. So what kind of opportunity set do you see in this rollover space in terms of your data? What are you showing?
So we size the IRA rollover market. So rollovers coming out of DC plans, defined contribution plans, into IRAs every year. We've sized it at more than $700 billion the last couple of years. And 2 years ago, it was about $780 billion. The total rollover market, so plan to plan plus IRA, was about $765 billion in 2023. And so this is an enormous market. Most of those...
So $765 billion in 1 year.
Yes, that's right.
Wow.
Yeah, it's enormous. And most of those rollover assets are going to advisor-assisted or advisor-intermediated rollovers. And most of those advisor-intermediated rollovers are going to existing advisor relationships. So, the thing we like to point to is that percentage that are going to existing advisor relationships. It's a huge portion of assets. About 85% of advisor-intermediated rollover assets go to existing advisor relationships rather than new advisor relationships. And so, the key takeaway here is that, Fidelity, Morgan Stanley, Bank of America, increasingly so, Schwab, understand is that you need to establish relationships with them before the rollover event.
And that gets back to your earlier point. This is the whole reason that advisors should want to get into the space, because you plant that flag early. And you get that. Yeah. And your data show, you kind of break it down into different cohorts of, I think it was only like 11% of the money came out was $1 million or more, which we know, I think in 401k plan assets, I think Fidelity has this data. What is it? 5% of the money is millionaires or something. Obviously, these people have their money spread all over the place, so you're not going to get a ton of 401k millionaires. So it's not like you're going to find one client who has all their money there. It's spread out among taxable accounts and IRAs and 401ks. But to your point, a lot of those 401k assets have been spoken for already. And that's the whole reason for financial advisors to get in here.
That's right. And your less affluent and younger investors are going to, on average, have a higher portion of their wealth tied to their 401k plan or DC plan. What we find, if we look at data from the Survey of Consumer Finance, we find that a larger portion of household wealth is held outside of the 401k plan for more affluent households. And so if you're looking at a participant with $1 million and $1 million in their 401k, well, they could have a spouse with a significant portion in their 401k or whatever retirement savings vehicle they're using. They could have a Roth IRA. They could have an HSA. They could have a 529 brokerage account, et cetera, et cetera, et cetera. And so what we also find in our 401k participant survey is that your more affluent participants are much more likely to have a health savings account. They're much more likely to have a 529, and they're much more likely to have a brokerage account. And so it all tells us that the more affluent participants are going to have more outside of the scope of that 401k, and advisors should be cognizant of that.
That makes sense. So for the advisors who want to become a dabbler, or they want to become more of a have it be part of their like where do they start to build relationships so they can come to these clients or the 401k providers, the corporations, or the small businesses where they have all the toolkits, in their toolbox when they're ready to go? Like, what do they need to come to the table with?
Yeah, I think it's the same. It's a similar question for any advisor, coming up, through the market. If you're a young professional recently graduated from college and you decide you want to be a financial advisor, it's an uphill battle those first handful of years, and a lot of advisors don't make it to build out sustainable businesses. There are a lot of educational tracks that advisors could use. There's the Retirement Advisor University that Fred Barstein runs. I was actually speaking with someone from Mosaic recently who was telling me about a program they have for younger advisors to get into retirement plan advisory. I think from an education standpoint, that's a good starting point.
There's some designations you can get, right?
Yeah, there's like the AIF designation through, there's something through FI360, which is a Broadridge company that you can get. There are different fiduciary CRPS. There are a handful of different retirement plan fiduciary designations that could be helpful as well. Yeah, but ultimately, I think it's going to be leaning, especially if you're already an advisor with a wealth book of business and you're affiliated with an IBD or with a wirehouse or with an RIA consolidator, maybe you're going to be leaning on your home office to provide you with the support to do that type of business. So are they going to have preferred funds that you're going to be able to select from for the plan lineup? Are they going to have home office curated 338 lineups? Do they have preferred record keepers that they're going to partner with you with? Do they have TPAs, third-party administrators, that are going to help you and your plan sponsor client handle a lot of that plan administration? So for a lot of big wealth firms, the big emphasis is making it simple for advisors to do retirement plan business, giving them that easy button rather than throwing them into the fray and say, hey, figure out how to do this business. So I think it's twofold: education and also leaning on the support of your home office.
So you talked about the consolidation in the 401k plan side of things itself. Is this just a situation where the rich get richer and the bigger firms are the ones who are ready to take advantage of all this opportunity here? They're the ones that continue to take this business and grow it. Is that where we are? Just is it going to be split between RIAs and the wirehouses basically?
Increasingly so with the RIAs, I think, because we're seeing a lot of consolidation both on the wealth, across the RIA market, and I've had several conversations with our RIA subject matter expert internally and my boss who have, we've kind of come together and had these conversations and around consolidation in the RIA space. It's a lot of it's PE backed. So there are a lot of PE firms backing these big RIA consolidator firms. And what we're seeing now is you've got these firms acquiring retirement-focused RIAs and retirement-focused RIAs acquiring wealth firms. So it's going between retirement-focused for RIAs and wealth-focused RIAs in every direction, right? So Mariner Wealth, huge wealth management-focused RIA, has acquired a few retirement plan consulting firms recently. Creative Planning acquired Locked In a couple years back, a huge retirement plan consulting firm. And then conversely, you see firms like CapTrust acquiring wealth management firms. So I do think you're going to have a handful of large RIAs who dominate the advisor-sold market in many cases. But I do think, to your point, Ben, there will also be the wirehouses who will also have a huge stake. And there are some IBDs that are doing a lot of retirement plan business too. So the wirehouses plus, LPL, Cetera, those firms, plus those RIA consolidators, I think will be 5, 6, 7 years from now, the firms that advise on the majority of advisor-sold DC assets.
And any advice? We have a lot of smaller RIAs that follow us. Any advice for those smaller firms? Is it mostly just about having some sort of niche, or is it just building relationships with your clients and hoping to get the business that way?
For them, it's probably starting with their wealth book and see where they can build out from there, and then maybe hiring some people with some retirement expertise. I know some firms have 1 or 2 people in house who are really, the retirement plan experts within that organization.
We hired experts to do it because we didn't have expertise in that space.
Yeah, and then you can refer all your retirement plan business to that individual, right? So
yeah, great, Shawn. This is excellent. Tell us, people want to learn more and follow your research. Where do they go?
You can go to Cerulli.com, and you can talk to some of our account managers, folks from our account management team. Drew O'Hearn, he'll probably have his contact information on our website, and go from there. And if you have any questions specific to our retirement research, you could reach out to me at sobrien@cerulli.com. I'm happy to respond to questions as my time becomes available.
Great, this was perfect. Remember, if you're an advisor, you need to sign up to the Unlock to receive more content about wealth tech, growth insights, practice management, and more. There's a lot of good stuff coming here. Sign up at advisorunlock.com, and we'll see you next time.